Good day everyone. My name is Tan Jun Yu and my material number is 299786. So in this video, I will explain the question quiz 3 step by step, including the formula used, the calculation process, and the economy reasoning behind each answer. Question 2a, I need to explain the 3 reasons why the supply of Ringgit Malaysia or RM might decrease in the foreign exchange market. First, the supply of RM decreased when Malaysian import favor goods. This is because Malaysian importer need less foreign currency such as USD to pay overseas supply. As a result, they sell less ringgit in forex market. When the supply of RM decrease, the RM becomes stronger. In ringgit per USD terms, the exchange rate falls. Malaysian importers and consumer benefit because import goods become cheaper. Second, the supply of ringgit decrease when Malaysian invest less overseas. For example, if Malaysian investor reduce their investment in US or Singapore asset, they do not need to sell as much ringgit to buy foreign currency. This reduce the supply of RM and cause the ringgit to appreciate. Firms with foreign currency debt may benefit because the cost of repayment become lower in ringgit terms. Third, the supply of ringgit may decrease when Malaysians spend less abroad, such as on overseas travel, education, or remittance. Since they need less foreign currency, they sell less ringgit. This also strengthened the ringgit. Therefore, in all three cases, the ringgit supply curve shift leftward and the ringgit appreciate. Question 2b, the Big Mac costs 15 ringgit in Malaysia and USD 5.50 in the United States. To calculate the BPP implied exchange rate, I divide the Malaysian price by the US price. So 15 ringgit divided by USD 5.50 equal 2.73 ringgit per USD. This means that based on Big Mac price, the fair exchange rate should be around 2.73 ringgit per USD. However, the actual market exchange rate is 4.20 ringgit per USD. Since the market rate is higher than the BPP implied rate, it means more ringgit is needed to buy $1 compared to what BPP suggests. Therefore, the ringgit is undervalued. To calculate the percentage undervaluation, I use the formula BPP rate minus market rate divide by market rate multiply by 100. The result is negative 35.1%. Therefore, the ringgit is undervalued by 35.1%. For question 2c, I calculate the BPP implied exchange rate today and the expected exchange rate after 2 years. The basket of good cost 5,500 ringgit in Malaysia and 1,250 USD in the US. For absolute BPP, I divide the Malaysian price by the US price. 5,500 ringgit divided by USD 1,250 equal 4.40 ringgit per USD. This is exactly the same as the current spot rate, which is RM 4.40 per USD. Therefore, absolute BPP is satisfied today. Next, I use relative BPP to calculate the expected exchange rate after 2 years. Malaysian inflation rate is 2.5%, while the US inflation rate is 3.8%. Since Malaysian inflation is lower than the US inflation, the RM should appreciate slightly against the USD. I use the formula current spot rate times 1 plus Malaysian inflation divided by 1 plus US inflation and then square it because the period is 2 years. The expected rate is RM 4.29 per USD. The exchange rate after 2 years is RM 4.30 per USD. This is slightly higher than the BPP implied rate of RM 4.29. Therefore, the RM is slightly weaker than PPP predicts. meaning the RM is slightly undervalued, however the difference is very small. For question 3a, I need to distinguish between a long position and a short position in the forward currency market. A long position means agreeing to buy foreign currency in the future at a fixed forward rate. This position is usually taken by importer or firm that have future foreign currency payable. The risk they want to hedge is that the foreign currency may appreciate, causing them to pay more ringgit in the future. For example, a Malaysian company importing machine from the United States may take a long US dollar forward position. This helps the company lock in the cost of buying US dollar, such as Simdabi Berhad. So on the other hand, a short position means agreeing to sell foreign currency in the future at a fixed forward rate. This is usually taken by exporter or firm with future foreign currency receivable. The risk they want to hedge is that the foreign currency may depreciate, causing them to receive favor ringgit. For example, a Malaysian palm oil exporter expecting to receive US dollar in the future may sell USD forward. This allows the exporter to lock in ringgit revenue and reduce uncertainty, such as FGV holding Berhad. 3B, the spot rate is 4.15 ringgit per US dollar and the 3-month forward rate is 4.09 ringgit per US dollar. To determine whether the US dollar is at a forward premium or discount, I compare the forward rate with the spot rate. The forward rate 4.09 ringgit is lower than the spot rate 4.15. This means the US dollar is cheaper in the forward market than in the spot market. Therefore, the US dollar is at a forward discount against the ringgit. Next, I calculate the annualized forward discount. I use the formula forward rate minus spot rate divide by spot rate multiply by 12 over 3 because the tenor is 3 months and then multiply by 100. So 4.09 ringgit minus 4.15 ringgit give negative RM 0.06 dividing by RM 4.15 and analyzing it give negative 5.78%. Therefore, the US dollar is at an annualized forward discount of 5.78%. 3C SimW will receive US dollar 1,200,000 in 3 months. Since the company will receive US dollar, it faces the risk that the US dollar may depreciate before the payment is received. To hedge the risk, SimW should take a short US dollar forward position. This means the company agreed to sell US dollar in the future at the forward rate. The forward rate is RM 4.09 per US dollar, so the RM revenue under the forward contract is USD 1,200,000 multiplied by RM 4.09. This gives RM 4,900,000 and 8,000. Without hedging, SimW could convert the US dollar at the actual spot rate in 3 months, which is RM 4.25 per US dollar. So US dollar 1,200,000 multiplied by RM 4.25 equal RM 5,100,000. To find the effect of hedging, I compare the two amounts. RM 4,900,000 and 8,000 minus RM 5,100,000 equal negative 192,000. This means hedging cost and opportunity loss of RM 192,000 compared with the actual spot outcome. However, the hedge was still reasonable because SimW used it to remove uncertainty. The company only know later that the spot rate would move in a favorable direction. In 6a, I explain 4 limitations of the traditional approach. The first limitation is that it ignores financial flow. The traditional approach mainly focuses on export and import. However, in modern forex market, exchange rates are also strongly affected by capital flow and investor decision. For example, Malaysian ringgit movement in 2024 and 2025 were influenced by US rate expectation and investor flow, not only trade. The second limitation is that it assumes slow adjustment. The J-curve explains that the trade quantity adjusts slowly over time. However, financial markets reach very quickly. Currency trade may respond immediately to news about the FED or BNM. The third limitation is that it cannot explain exchange rate overshooting. Sometimes exchange rate moves much more than trade fundamentals suggest. For example, the Malaysian ringgit weakening to high level reflect financial sentiment and pressure, not only trade deficit. The fourth limitation is that it ignores monetary policy. The traditional approach does not directly explain how interest rate and money supply affect exchange rate. In Malaysia, BNM OPR decision can affect the Malaysian ringgit through monetary and portfolio channel. Therefore, the monetary and portfolio approach are needed to explain modern exchange rate movement more completely. 6B, I use both the monetary approach and the portfolio balance approach to explain the effect of Malaysia's strong GDP growth. Under the monetary approach, strong GDP growth increase economic activity. Then, when people and firms conduct more transactions, the demand for money or MD increase. If money supply does not increase equally, then money demand is greater than money supply. This creates a BOP surplus condition and support ringgit Malaysia appreciate. Under the portfolio balance approach, foreign investors may see Malaysia's stronger GDP growth as a positive signal. As a result, they may rebalance their portfolios by buying more Malaysian equity bonds or deposit. This brings capital inflow into Malaysia. When foreign investors buy Malaysian asset, they need ringgit Malaysia. Therefore, the demand for ringgit Malaysia increased and the ringgit Malaysia appreciate. In conclusion, both approach give the same direction. Strong GDP growth support the ringgit Malaysia. The monetary approach explain it through higher money demand, while the portfolio approach explain it through capital inflow. For question 6C, a risk of environment happen when global investors become more cautious and avoid risky assets. Flight to safety means investors move their fund into safer assets, such as US Treasury bonds, USD deposit, or other highly liquid assets. Using the portfolio balance approach during a risk of environment, investors may reduce their demand for Malaysian bonds and ringgit Malaysia deposit because Malaysian is considered risky compared to safe haven market. As a result, capital may flow out of Malaysia or new capital inflow may slow down. Investors sell ringgit Malaysia and buy US dollar. This causes the ringgit Malaysia to depreciate. To support the ringgit Malaysia, BNM could raise or maintain the relatively attractive OPR under the portfolio approach. A higher OPR make Malaysian bonds and deposit more attractive to investors. Under the monetary approach, a higher OPR tightens monetary condition and support ringgit Malaysia value. 8A, I explain the three types of foreign exchange risk exposure faced by multinational company. The first type is transaction exposure. This happens when exchange rate changes affect a specific foreign exchange payment or receipt in the future. For example, a Malaysian palm oil exporter expects to receive US dollar in 3 months. If the US dollar depreciates against the ringgit Malaysia, the exporter will receive favor ringgit after conversion. This reduces revenue. Firms usually manage this risk using forward contracts or other hedging tools. The second type is translation exposure. This is an accounting risk. It happened when a multinational company convert the financial statement of foreign subsidiary into the parent company currency. For example, Petronas may have overseas subsidiary with asset record in US dollar or Europe. If those currency depreciate against the ringgit Malaysia, the translate value of asset and profit will appear lower in Petronas consolidated financial statement. The third type is economic exposure. This is the long-term risk that exchange rate change affect a company future sales, cost, competitiveness, and profits. For example, if the ringgit Malaysia appreciate, the Malaysia rubber or electronic export become more expensive for foreign buyer. This may reduce foreign demand and future revenue. If the ringgit Malaysia depreciate, import raw material become more expensive, increasing production costs. For question 8b, the current spot rate is RM 4.50 per US dollar, while the 3-month forward rate is RM 4.44 per US dollar. To calculate the annualized forward premium or discount, I use the formula forward rate minus spot rate divided by spot rate multiplied by 12/3 and then multiplied by 100. The forward rate is RM 4.44 and the spot rate is RM 4.50. So RM 4.44 minus RM 4.50 equal negative RM 0.06. Then I divide by RM 4.50 and multiply by 4 because the forward contract is for 3 months. The result is negative 5.33%. Since the result is negative, the US dollar is at an annualized forward discount of 5.33%. This means the US dollar is priced weaker in the forward market. At the same time, the ringgit Malaysia is priced stronger in the forward market. For question 8c, the Malaysian palm oil exporter will receive US dollar 600,000 in 6 months. The exporter enter a forward contract to sell US dollar at RM 4.22 per US dollar. The actual spot rate after 6 months is RM 4.10 per US dollar. First, I calculate the ringgit Malaysia revenue under the forward contract. US dollar 600,000 multiplied by RM 4.22 equal RM 2,532,000. Second, I calculate the ringgit Malaysia revenue without hedging. If the exporter did not hedge, the US dollar would be sold at the actual spot rate of RM 4.10. So US dollar 600,000 multiplied by RM 4.10 equal RM 2,460,000. Next, I compare both amount. RM 2,532,000 minus RM 2,460,000 equals 72,000 ringgit. Therefore, the exporter gain RM 72,000 by hedging. The decision is hedged by justified because the forward contract protected the exporter from US dollar depreciation. For question 9a, I need to determine whether covered interest parity or CIP holds. First, I calculate the return from investing RM 100 in Malaysia. Malaysia interest rate is 5%, so RM 100 multiplied by 1.05 equal RM 105. Next, I calculate the covered return from investing in the United States. I first convert 100 ringgit into US dollar using the spot rate of RM 4.50 per US dollar. RM 100 divided by RM 4.50 equal US dollar 22.22. Then I invest the US dollar at the US interest rate of 3%. US dollar 22.22 multiplied by 1.03 equal US dollar 22.89. After that, I use the 1-year forward rate of 4.41 ringgit per US dollar to convert the US dollar back into ringgit Malaysia. US dollar 22.89 multiplied by RM 4.41 equal about RM 100.95. So the Malaysian investment give 105 ringgit, while the cover US investment give only 100.95. Since the return are not equal, CIP does not hold. I also calculate the CIP implied forward rate using the formula spot rate times 1 plus Malaysian interest rate divided by 1 plus US interest rate. This gives RM 4.59 per US dollar. However, the actual forward rate is only 4.41 ringgit, so the forward rate is too low. To restore equilibrium, a budget would prefer Malaysian asset. They may borrow US dollar, convert it into ringgit Malaysia, invest in Malaysia, and buy US dollar forward to repay the US dollar loan. This process increase demand for ringgit Malaysia in the spot market and demand for US dollar in the forward market until covered return become equal. For question 9b, I use uncovered interest parity or UIP. The investor was RM 100,000. Malaysia interest rate is 5% and US interest rate is 3%, and the spot rate is RM 4.50 per US dollar. First, I calculate the expected exchange rate under UIP. I use the formula spot rate times 1 plus Malaysian interest rate divided by 1 plus US interest rate. So RM 4.50 multiplied by 1.05 divided by 1.03 equals RM 4.59 per US dollar. Second, I calculate the expected ringgit return if the investor invests in Malaysia. RM 100,000 multiplied by 1.05 equal RM 105,000. Third, I calculate the expected RM return if the investor invests in the US. First, RM 100,000 divided by RM 4.50 give US dollar 2222.22. Then investing this amount at 3% gives US dollar 22,888.89. Finally, converting back at the expected exchange rate of 4.59 ringgit give approximately RM 105,000. Therefore, both investment give approximate the same expected return. This shows that under UIP, expected exchange rate change offset the interest rate difference. Question 9c. When foreign investor increase their investment in Malaysia because of a better sovereign credit rating and stronger than expected GDP growth, more foreign funds enter Malaysia. This increased the supply of loanable funds in Malaysia. In the loanable funds market, when the supply of funds increase, the interest rate tends to fall because there are more funds available for borrowing and investment. At the same time, foreign investors need to buy ringgit Malaysia in order to purchase Malaysian asset. Therefore, the demand of ringgit Malaysia increased in the foreign exchange market. This caused the ringgit Malaysia to appreciate. Over time, the lower Malaysian interest rate reduced the excessive attractiveness of Malaysian asset. This helped restore equilibrium in both the loanable funds market and the foreign exchange market. For question 10a, the Fisher equation say that the real interest rate is equal to the nominal interest rate minus expected inflation. For Malaysia, the nominal interest rate is 5% and expected inflation is 1.5%. So the real interest rate is 5% minus 1.5%, which equal 3.5%. For the United Kingdom, the nominal interest rate is 4% and expected inflation is 2.5%. So the real interest rate is 4% minus 2.5%, which equal 1.5%. Malaysia has the higher real interest rate, therefore real interest parity predict that capital will flow from the UK to Malaysia because investors prefer the higher real return. If capital flow freely, capital inflow into Malaysia will increase the supply of loanable fund in Malaysia, causing Malaysian nominal interest rate to fall. At the same time, capital outflow from the UK reduce the supply of fund in the UK, causing the UK interest rate to rise. Eventually, real interest rate will move toward equality, although nominal rate may still differ because inflation rate are different. For question 10b, the J-curve effect show that After currency depreciation, the trade balance may worsen first before improving later. In phase 1, which is the immediate period around 0 to 3 months, import price in Ringgit Malaysia rise immediately. However, import volume does not fall quickly because many contracts are already fixed. Export volume also does not increase immediately. Therefore, the trade balance worsened. In phase 2, around 3 to 6 months, import volume start to fall slowly as consumer and firms begin to adjust. Export volume also increase slowly. However, the trade balance may still remain weak. In phase 3, around 6 to 18 months, consumer and firms substitute away from expensive import. At the same time, foreign buyer demand more Malaysian export because Malaysian goods are now cheaper. Therefore, the trade balance start to improve. In phase 4, after 18 months, import volume fall more clearly and export revenue increase. If the Marshall-Lerner condition is satisfied, the trade balance improve in the long run. Using Malaysia as an example, Ringgit Malaysia depreciation in 2023 and to 2025 may have increased import costs at first, but over time it could improve export competitiveness and support the trade balance. 10C, Malaysia RM depreciated by 10% against the US dollar. The export demand elasticity is 0.4 and the import demand elasticity is 0.3. First, I check the Marshall-Lerner condition. The condition is satisfied only when the sum of export and import demand elasticity is greater than 1. Here, 0.4 plus 0.3 equals 0.7. Since 0.7 is less than 1, the Marshall-Lerner condition is not satisfied. Next, I calculate the change in export value. The export value increased by 10% multiplied by 0.4, which equals 4%. Then I calculate the change in import value. Import value decreased by 10% multiplied by 0.3, which equal 3%. The trade balance worsened because the volume response is too small. Import become 10% more expensive in RM terms, but import quantity fall by only 3%. Export quantity increased by only 4%, which is not enough to offset the higher import cost. Therefore, because the Marshall-Lerner condition is not satisfied, the depreciation does not improve the trade balance. So, in summary, I explain each answer by applying the relevant concept, formula, and economic reasoning, including PPP, forward premium and discount, hedging, monetary and portfolio approach, CIP, UIP, real interest parity, and J-curve effect, the Marshall-Lerner condition. Thank you.